Welcome to How the Machine Works, the series that takes one piece of financial machinery and shows you what it actually does. Today, the most famous recession signal in the world. The yield curve has rung before every American recession for more than half a century, with a single false alarm. Most explanations stop at the chart. We're going underneath it, because once you see why it works, you'll never read the headline the same way again. Strip the jargon. When you lend the government money, you get paid interest, and the longer you lend for, the more you normally demand. Plot that. 3 months, 2 years, 10 years, 30. The line usually slopes upward, like a hillside. That line is the yield curve, and its slope is one of the most information-dense prices on Earth, because it isn't set by any official. It's millions of investors voting with real money on what the next decade looks like. Now the strange event. Sometimes the hillside flips. Short-term money starts paying more than long-term money. Lending for 3 months earns you more than lending for 10 years. That's called an inversion, and it should feel wrong, because it is. Investors are accepting less for a decade of risk than for a season of it. There is only one reason to do that. They believe rates, and the economy underneath them, are heading down, and they want to lock today's income before it disappears. Here's the part most explainers miss. The inversion isn't just a prediction, it's a cause. The entire banking system runs on one trade: borrow short, your deposits, and lend long, mortgages, business loans. The gap between those two rates is the bank's profit margin. Invert the curve, and that margin goes negative. Every new loan becomes a money loser, so banks quietly stop making them. Credit, the oxygen of the economy, gets rationed, months before anyone announces anything. The signal and the disease are the same event. Now the track record, honestly stated. Since the late 1960s, every single American recession has been preceded by an inversion of this curve, usually 6 to 18 months in advance. One false alarm, in 1966, when the economy slowed but escaped. And note the fine print on the most recent entries. The curve inverted in 2019, and the recession that followed had a virus for a trigger. Economists still argue about that one. An honest instrument keeps its misses on the card. That's still the best long-range record of any macro signal we have. So why does anyone still get caught? Because of the gap. 6 to 18 months is long enough for the all-clear chorus to start, and it always starts the same way, with the 4 most expensive words in finance. This time is different. In 2006, the inversion was explained away as foreign savings flooding into bonds. In 1929, an episode we've told in full, short money sat above long money for a year while the market climbed. The curve is not a starting pistol. It's a regime marker. It tells you which neighborhood you're standing in, never the day of the storm. One more layer, and it's the one professionals watch. Historically, the recession doesn't tend to start while the curve is inverted. It starts when the curve snaps back. When short rates collapse because the central bank is suddenly cutting, the curve uninverts fast. And that re-steepening has been the nearer alarm before downturns for decades. So read it as 2 bells. The inversion says the neighborhood has changed. The violent steepening afterwards says the weather has arrived. 2 different sounds. Most headlines only report the first. So, where does the needle sit this morning? As of this recording, in the middle of July 2026, the curve gauge on our board is lit, and it is ringing the second bell, not the first. The curve spent roughly 10 of the last 24 months inverted, and it has since snapped back to a positive slope, the re-steepening this episode taught you to treat as the nearer alarm. One caveat rides with every modern reading, and the board carries it honestly. In the era of central bank bond buying, shallow inversions carry less information than their 20th century ancestors. The 2022 inversion resolved without a recession, and that miss stays on the card. The neighborhood has changed. The gauges are watching the weather. The full board is live at agenticsovereigncapital.com/bubblewatch. The curve is one of 7 gauges, every reading dated, every false alarm published. This episode is education, not investment advice, and nothing in it is a recommendation. Next on How the Machine Works, another piece of the machinery everyone quotes and nobody explains.